Today, growth weakens as the inflation monster stirs. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. In today's post, we look at some of the macro trends and try and work out whether inflation is real, imaginary, and whether it's going to hang around, and if it does, what the implications may be. In its latest World Economic Outlook, just released, the International Monetary Fund says the global economic recovery has lost momentum and is becoming increasingly divided. The sense of optimism that had propelled markets in the first half of the year is at risk of fading. Investors have become increasingly worried about the economic outlook amid ever greater uncertainty about the strength of the recovery. Uneven vaccine access, along with the mutations of the COVID-19 virus, have led to a resurgence of infections, fueling concerns about more divergent economic prospects across countries. Inflation readings have been above expectations in many countries, and new uncertainties in some major economies have put markets on alert. These uncertainties are triggered by financial vulnerabilities that could increase downside risks, surging commodity prices, and policy uncertainty. The deterioration in market sentiment since the April 21 Global Financial Stability Report resulted in a significant decline in global long-term nominal yields in the summer, driven by falling real rates, reflecting concerns about long-term growth prospects. But in late September, investor anxiety about inflationary pressures pushed yields higher, as price pressures then started to be seen as potentially more persistent than initially anticipated in some countries, entirely reversing earlier declines. So they now expect output to expand 5.9% worldwide this year. That's down 0.1 percentage point from what it anticipated in July, and then a bounce from the 3.1% contraction of 2020. But they held their forecast for 2022 at 4.9%. The fund cautioned that inflation risks are skewed to the upside, and those for growth are tilted to the downside. That's the wrong way around, of course. The fund warned threats to growth have increased, pointing to the Delta variant, strained supply chains, accelerating inflation, and rising costs for food and fuel. The aggregate figure also masks huge downgrades for some countries, especially low-income nations where access to vaccines remains limited. Overall, risks to economic prospects have increased and policy trade-offs have become more complex, Geeta Golopath, the fund's Director of Economic Research, said in the report's introduction. The dangerous divergence in economic prospects across countries remains a major concern. With investors increasingly worried about the threat of stagflation, the IMF provided some comfort by saying inflation will subside to 2% in advanced economies by the middle of 2022, after peaking in the final months of this year. But it's betting emerging and developing economies will still see consumer prices gain 4.9% next year, after 5.5% this year. Among the world's biggest economies, the IMF cut its forecast for the US by a full percentage point to 6% in 2021, mainly because of supply constraints, but boosted its 2022 estimates to 5.2% from 4.9%. China, they say, will grow at a rate of 8% this year and 5.6% next, both a decline of 0.1 points from July. And it raised its projection for the euro area to 5% this year from 4.6%, and kept its 2022 estimate at 4.3%. Forecasts for Japan, the UK, Germany and Canada were all cut for this year, but lifted for 2022, and low-income countries were tipped to advance just 3% this year. That's a slice off of 0.9% from July. The IMF calculated gross domestic product for advanced economies will regain its pre-pandemic levels in 2022 and even exceed it by 0.9% in 2024, but only 2/3 were seen regaining their earlier employment levels. In contrast, it reckoned emerging and developing markets would still undershoot their pre-pandemic forecast by 5.5% in 2024. The disparity is based chiefly on differences on vaccine access and policy support. About 60% of people are vaccinated against COVID-19 in rich countries, but less than 5% in low-income nations, it said. Emerging economies are also withdrawing policy support more quickly and face outsized pain from costlier food. Central banks were told they could generally look through transitory inflation and avoid tightening monetary policy until they can secure more clarity. But they say they should be prepared to act quickly if their economies strengthen faster than expected or if inflation expectations build. And they make the point that if investors at some point reassess abruptly the economic and policy outlook, financial markets could endure a sudden repricing of risk, and that repricing, if sustained, could interact with underlying vulnerabilities, leading to a tightening of financial conditions. And this could put economic growth at risk. Risk also bears close monitoring in other areas. They said crypto asset markets are growing rapidly and crypto asset prices remain highly volatile. Financial stability risks are not yet systemic in the crypto ecosystem, but risks should be closely monitored given the global monetary implications and the inadequate operational and regulatory frameworks in most jurisdictions, especially in emerging markets and developing economies. And likewise, as the world continues to seek ways to speed up the transition to a low greenhouse gas economy, in order to avoid the negative economic and financial stability outcomes associated with climate change, a promising opportunity is emerging in the financial sector. They said while assets under management in climate-themed investment funds remains relatively small, inflows have surged and there is a promise of cheaper funding costs for climate-friendly firms as well as greater climate stewardship by funds. Amid still too easy financial conditions overall, their analysis finds that financial vulnerabilities continue to be elevated in several sectors, but are masked in part by the massive policy stimulus. Policymakers are now confronted with a challenging trade-off. They must continue to provide near-term support to the global economy, even as they must simultaneously try to avoid the build-up of medium-term financial stability risks. Managing this trade-off is a key challenge confronting policymakers. A prolonged period of extremely easy financial conditions during the pandemic, which certainly has been needed to sustain the economic recovery, has allowed overly stretched asset valuations to persist. They said if that overstretch continues, it may in turn intensify financial vulnerabilities. Some warning signs, for example, increased financial risk-taking, as well as rising fragilities in the non-bank financial institutions sector, point to a deterioration in the underlying foundations of financial stability. If left unchecked, such vulnerabilities may persist into the longer term and become structural issues. In financial markets, the IMF says that stretched asset valuations meant investor sentiment could shift rapidly by adverse news on the pandemic or policy amid pressing concerns of the impasse over the US federal debt limit and possible weaknesses in China's property sector. And as a meeting of international governments on fighting climate change nears at the end of the month, the fund says stronger concrete commitments are needed, including tailored international carbon price floors and $100 billion of support for developing nations. And it also called again on rich countries to channel a recent bolstering of IMF resources to more needy counterparts. Looking further out, the fund said if COVID-19 has a prolonged impact, it could reduce global GDP by $5.3 trillion over the next 5 years relative to current projections. That could be offset if governments intensify efforts to equalize vaccine access. This has consequence for investors, with the recent synchronized sell-off in equities and treasuries likely just the beginning of what's come for the popular 60-40 stock bond portfolio strategy. A growing chorus of Wall Street strategists warn. Bank of America called it the end to the 60-40, while Goldman Sachs said losses from such portfolios could swell to 10%. Similar alarms also rang at Deutsche Bank, where strategists, including Jim Reed, said a shift in the stock-bond relationship may force money managers to adjust their thinking. Underpinning all these warnings is an economy that's now facing mounting inflationary pressures after spending years warding off the threat of deflation. During the last 2 decades, subdued growth boosted the allure of the 60-40 strategy, one that's built on the negative stock-bond correlation, where one serves as buffers for the other. Now, with inflation fears raging, the worry is the Federal Reserve will seek to slow down the economy, and rising rates will spell trouble for both bonds and stocks. September offered a taste of the pain, with a tracking portfolio of 60% stocks and 40% fixed income securities suffering the worst monthly drop since the pandemic started in early 2020. Obviously, for this relationship to reverse, we need to be in a sustainably higher inflation era, Reed wrote in a client's note. There is every chance we are in one, and if so, a lot of the relationships that have prevailed in the average person's investment career could change. The stakes are high. A sustained shift in the bond-stock relationship would unsettle trillions of dollars that are managed at risk parity funds, balanced mutual funds, and pension funds that follow the framework of 60-40 asset allocation. To be sure, the death of 60-40 has been pronounced before, only to be proved wrong or at least premature. At Goldman Sachs, strategists there said the growing dominance of technology shares meant the S&P 500 has become a much longer duration asset, where the present value of future earnings is more sensitive to moves in interest rates. That means rates volatility would spill over to equities, leading to a larger risk contribution from bonds to balanced portfolios. By Goldman's calculations, a measure of 60-40 portfolios has dropped 4% in the past month. And continuing the uncertain picture, the US Bureau of Labour released their job openings and labour turnover report for August, and it showed that a record number of US workers quit in August, potentially signalling more trouble ahead for businesses already struggling to fill some 10.4 million open jobs. The government on Tuesday reported US job openings fell in August from an all-time high. On the last business day of August, the number and rate of job openings decreased to 10.4 million, down 659,000 or 6.6%. Job openings decreased in several industries, with the largest decrease in healthcare and social assistance, down 224,000, accommodation and food services, down 178,000, and state and local government education, down 124,000. In August, the number and rate of hires decreased to 6.3 million, down 439,000 and 4.3%, respectively. Hires decreased in accommodation and food services, down 240,000, and in state and local government education, down 160,000. Total separations includes quits, layoffs and discharges and other separations, and in August the number and rate of total separations was little changed at 6 million and 4.1% respectively. But even more noteworthy was a record number of people leaving their jobs. The so-called quit rate climbed to 2.9% overall and to 3.3% for private sector employees. Both are the highest figures on record since the government began to keep track in 2000. Altogether, a record 4.27 million people quit their jobs in August. By contrast, just half as many had quit during the early stages of the pandemic. Now, generally, more people quit when the economy is doing well or they think they can find a better job. They tend to stay put when the economy is bad. At the height of the coronavirus crisis, for example, the quit rate fell to a 7-year low of 1.8%. The rise in the number of people quitting their jobs coincided with a spike in coronavirus cases tied to the Delta variant, potentially explaining part of the increase. But at the same time, many employees are switching jobs to earn higher pay from competing companies desperate to fill open positions and willing to pay more, economists said. Many companies complain they cannot find enough workers to keep production going at full tilt and take advantage of strong demand for their goods and services, and millions of people who had jobs before the pandemic still haven't returned to work. These labour shortages, along with the scarcity of business supplies, are holding back the US recovery and threatening a broader slowdown unless they relent. The combination of a record number of people quitting and fewer people looking for work compared to pre-pandemic times likely means more struggles ahead for US businesses. They have plenty of demand, but they simply can't keep up. And the labour shortage is expected to ease in the next year or so if coronavirus cases continue to decline, especially after the end of generous unemployment benefits provided by the government during the pandemic. The extra benefits expired last month. And the BLS make the point that large numbers of hires and separations occur every month throughout the business cycle. Net employment change results from the relationship between hires and separations. When the number of hires exceed the number of separations, employment rises, even if the hire level is steady or declining. Conversely, when the number of hires is less than the number of separations, employment declines, even if the hires level is steady or rising. And over the 12 months ending in August 21, hires totaled 72.6 million and separations totaled 66.7 million, yielding a net employment gain of 5.9 million. Those totals include workers who may have been hired and separated more than once during the year. So once again, the level of economic uncertainty is on the rise, and if the market catches on, it could well signal a significant turn, though on the other hand, for now, most still think central banks will keep them safe, QE and low rates. And yet, as Bloomberg's John Orthans wrote, by the end of last week, the bond market was showing clear signs of losing its nerve over inflation again. Moreover, this wasn't a uniquely American phenomenon. German inflation break-evens, the implicit inflation forecast that can be derived from the bond market, are at their highest in 8 years, even as they remain below 2%. In the US, forecasts for both the next 5 years and the 5 years after that are close to the highs they touched during the brief inflation scare in the spring. But even if there is some clarity that inflation is a problem again, it's not because of any overheating. Incoming economic data for the world as a whole has generally been disappointing for the last few months, and on balance, they are inflicting negative surprises, as indicated by the Citi Global Surprise Index. And meanwhile, in the US, Robin Brooks, chief economist at the Institute of International Finance, notes data surprises are now running significantly negative. Importantly, they are notably more negative than in 2013, when bond yields surged in apprehension of tapering of quantitative easing by the Federal Reserve. The big stylized fact of the last few months is that the recovery from COVID is way slower than the markets have been expecting, Brooks said. But don't blame Delta. Absent the arrival of a truly terrifying new variant that is lethal and also impervious to all the vaccines that we have at present, it looks as though we have reached the point where the market is no longer that concerned about the pandemic's medical progression. There is general optimism that it needn't be as horrifyingly damaging in the future, along with pessimism that it's bound to become endemic. That raises the issue of just why bond yields are surging and the stock market is wobbling. Plainly, the worry is that inflation is back and it won't be transitory. The bottom line is that inflationary pressure is indeed broadening, and this shows up most clearly in commodities markets, in the labour market, and in complaints from businesses that they are wrestling with higher prices. And of course, US CPI comes out later today, and that will be one to watch. But if indeed it is true that inflation is getting embedded, that changes a lot of things. Markets are overvalued. They will have to correct. And by the way, that could also flow over into house prices too. So levels of uncertainty higher and inflation pressures higher too. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.